Welcome to Making the Deal, Frameworks for Transactions. This podcast is focused on lower middle market transactions and how to bring them to a close. I'm Shawn Mercino.
I'm Joe Allen. As a quick recap, I've been in the investment banking space for 18 years now. Shawn has been in the banking space providing funding solutions for his clients for going on 10 plus years now. Yeah. So our backgrounds give us a little bit of a good jumping off point to start some conversations around transactions with people. Today we have another fantastic guest with us that we're super happy that we were able to pull in, Don Price from Bodmer Price. Don, thank you for joining us, and why don't you give us a brief little background on you and your firm?
Sounds good. Thanks, gentlemen. I appreciate the invite to be part of this podcast. I'm really looking forward to it. I got about 20 years of valuation experience. I'm a partner at a boutique valuation firm called Bodmer Price. There's about eight of us that work there. I specialize in business valuation, litigation support services. I've done probably 1,000 engagements over my 20-year career, which ends up being about 50 per year. So I got vast experience in valuing all types of companies, whether it's manufacturing, distribution, staffing, auto dealerships, professional practices. Pretty much anything that has a value or needs a value, I can do it. Typically, I always say if it's got cash flow, we can value it. So that's a little bit about me, and I'm looking forward to this podcast.
Awesome.
Yeah, we appreciate you being here.
Yeah, thanks for being with us, Don. We're excited to dive in. Before we do that, just kind of want to remind everybody some of the podcasts that we've had so far. We talked about the key components in every transaction. We talked about some of the key legal documents on the front end in the form of a letter of intent, term sheet, purchase agreements. And then we dived into the deal team. Who's on that team? Valuation expert, CPA, attorney, kind of everybody involved in that space. So we've been excited to bring those to you so far. Hopefully you've had a chance to check them out. Let us know if you have any thoughts, any feedback. If there's any content that you guys haven't seen from us or want to see in the future, let us know. Really love to hear you engage with us. We're on LinkedIn, Instagram, soon to be Spotify and Apple. So keep an eye out for that. But Don, thanks for joining us today.
Yeah, so at this point, let's dive in a little bit, right? We've got the expert here, so let's talk about what we're here to talk about. Sure. So business valuations, and specifically how it plays into a transaction, whether that be a funding or an M&A transaction or a tax planning event. So there's a couple of key points we want to touch on. So one, first of all, valuations are very ambiguous because valuation experts, they can come up with very different values for the exact same company just based upon the data that they see in their experience looking at various transactions, right, Don?
Sure.
There's obviously a lot of uses, which we'll dive into, but there's a lot of different uses. So like we said, there's fundings, there's estate planning situations, there's M&A transactions. There's a lot of different uses for valuations, and they're all very important for those transactions.
Right.
And then, today I'm really excited to get into the actual ways in which you do valuations. So what are the different methods? How do you go about doing it? That's data that most people are not privy to. So I think that's going to be really value add for people here today to have somebody like Don on that can speak to these types of things. So that being said, let's dive in. You've got a couple different kind of valuations that are typically in a transaction. So there's two that are very important to transactions, a lot on the lending side.
Collateral based for sure.
Correct. Would be your equipment valuation or appraisal or your real estate appraisal. Each of those are going to have their own professional who is providing those documents. Some of which you're going to use at certain times in your business valuations, right?
Of course.
But a professional like yourself who's focused on business valuations, you're not going to be doing those types of valuation. That's not where your skill set lies, right?
That's correct.
Right. So you've got real estate and equipment, then you've got the business valuation. And that's where we're going to focus today. We're going to spend all our time today talking about these business valuations and how they tie in. So
Sure.
Perfect.
Yeah. So Joe, you mentioned a few of the uses and the different types. One that comes to mind from a banker's perspective is for funding purposes. right? That really is value of the company drives what somebody can lend. I think of an SBA situation, right? The SBA program, when they're lending, they're tied to what the valuation yields. That's the maximum they can lend.
Correct.
So it's important in that situation. Any kind of senior financing on a conventional basis is also going to need to know the value of the company. But then you get into some of the other types, right? Like seed financing, angel investors, venture capital. When you're pre-revenue or maybe not even pre-revenue, maybe you have revenue, but you're not making money. Another important place for valuations to come into play. Don, what have you seen in kind of that space, in the funding space?
Sure. Obviously, when you're valuing an early stage company or a tech company that has, either negative earnings or, as you mentioned, very little revenue, you're typically looking at doing a valuation mainly on an income approach, because you can't really utilize. You can look at a market approach to kind of support certain valuation multiples, but the main method you want to look at is an income approach. And one of the biggest components when you're valuing an early stage tech company like that is the overall cost of equity or the weighted average cost of capital. And for these types of companies that are underperforming or pre-revenue or not making enough money, you're going to look at rates of return of somewhere between 30 and 60% potentially, because a lot of these young startup companies, they end up failing, right? They end up not making it. So you have to really make sure that the risk profile of that business is actually factored into the valuation.
Right.
And Don, just for frame of reference, when you talk about the cost of equity in that scenario, where is that compared to maybe a manufacturing company that's, had revenue for 50 years, had earnings for X number of years? What are the cost of equity differences?
Sure. So if you're looking at more of a mature company that, like you said, that's been around for 20, 25 years, they have steady earnings year over year, revenue's pretty steady year over year, you'll typically have a cost of equity somewhere in that 18 to 25% range.
So it's a big difference.
Correct. And then when we're looking at valuation, you also have to look at what we look at as the weighted average cost of capital, right? So when you look at the weighted average cost of capital, that's a blend of debt, which is cheaper than equity, right? You can obviously get debt at a much cheaper rate, somewhere in that 6 to 10% as a range. And then if you're looking at equity, obviously equity is a lot more expensive. So usually you got to look at the mix of that weighted average cost of capital. Typically, it's going to be a little bit more equity than debt. You'll probably have, in my experience, depending on the industry, somewhere between 10 and 30% debt, and then the rest is usually funded with equity.
Okay.
Yeah.
Okay.
Yeah, that's great. And look, to your point, I always, for my entire career, I've been telling my clients, equity is the most important money you can take on. Like,
Sure.
The value of your company is, if you actually believe in what you're doing, like that. Yeah, there's a risk. You might have to sign a PG. You might have to do some of these things, but equity is expensive.
Right.
Yep. Okay, so that's great. We think we're covered on the funding side as a starting point. Yeah. Okay, let's dive into mergers and acquisitions, M&A. Very important to these situations. So, majority of people who call me about a sale of their business, their first question is, what is my company worth?
Sure. How much can I make?
Yeah, right, exactly. And,
Right.
and there's certain situations where I'm like, okay, like I can give you a general idea as a multiple of EBITDA or something like that based upon the industry and that kind of stuff. But if you want like a real number that you say, this is the number, you want to talk to a valuation expert. So maybe give us just a little bit of detail about how you go about like where you see these falling into M&A transactions. Like what are the situations that you typically run into in these situations?
Yeah, certainly, especially the older generation, right? So a lot of the younger generation is not really taking over the business, right? So we've seen a lot of companies that are selling and the kids don't want it, right? So and then the one mistake they do make, and they need to talk to somebody like Joe, obviously, if they're thinking about selling, they should plan ahead 2-3 years into the future. Because what that's going to do is it's going to put your company in position to get a higher revenue multiple or a higher EBITDA multiple and get more value for yourself. So I think that's one of the most important things to consider.
Yeah, and look, I've been really, really trying to beat my clients over the head to tell them to start planning 2 to 3 years, because the people that come to me and they're like, look, I want to be out in the next 3 months,
It's a fire
in the next
sale
6 months.
situation.
Yeah,
Right.
like you're not maximizing your proceeds.
Correct.
And then on the other side of that, when they're doing that, they should be doing it to make sure that they're going to get enough proceeds to actually retire and also plan for tax events. But if you don't know how much money you're going to get at the end of the day, you may not be prepared for retirement, right?
Right.
So having these valuations, being ready. Look, if I need $8 million to survive for the rest of my life, which is a very nice living, but if that's something you need, and somebody comes to you 2 to 3 years before they're ready to retire, and they say, "Look, my company's only worth $4 million. I'm going to have to keep working forever." Well, at least this gives them an opportunity now to work with a professional who can help them build that valuation up. And maybe you just do an update every year. Like maybe they come back to you each year and say, "Hey, Don, where am I at now? Don, where am I at now?"
Sure.
And once they hit that milestone, they know they're actually ready for that exit event.
Agreed.
Okay, so you mentioned tech companies. So it's kind of crazy. You look at Wall Street, right? And highest valuations are for some of these tech companies that are not cash flow positive.
Sure.
They're still bleeding money. They're still selling more shares. They're still doing fundraising events, right? Can you tell us a little bit about why these valuations for those companies can be so high as opposed to companies that have maybe in a more mature part of the life cycle,
right?
But they're kicking off tons of money.
No, you're absolutely right. So when you look at early stage tech companies or software companies, software specifically, it's all about the intellectual property, right? So they develop the intellectual property, and that's going to be used somewhere else at some point, right? Ultimately, they're going to sell it. And they sell for just ridiculous multiples, these software companies. I mean, it's not uncommon to see 10, 15 times revenue on some of these software companies. So it's all about the intellectual property that they own and that they've developed, which there was a significant amount of money that was put into that intellectual property.
Yep.
Right.
Yeah, it's kind of crazy. I mean, sometimes I have people come to me and they're like, "Well, we have a $150 million valuation." I'm like, "Good for you."
You lost 400.
Yeah, right. Exactly.
Right.
It'll leave you scratching your head sometimes, but it's understandable. It's all about the future,
Exactly.
Possibilities, right?
Valuation is always based on prospective cash flow. Right?
Yeah.
So.
Yeah, absolutely. And then as we said, planning for that tax event. You start getting into that stuff now. There's multiple situations where you're going to use a valuation for future tax events. So when you're selling your company, you want to be looking at a couple of important things, right? Gift tax is a big one because you should be working. Correct me if I'm wrong, but your valuation expert is going to have a big impact on what your estate and tax attorney is going to suggest that you do, your tax attorney, your CPA. I mean, you're regularly doing valuations for these professionals, correct?
Absolutely. So right now, the gift tax exemption, the lifetime exemption, it's going to sunset on 12/31/2025, and it's a little over $13 million per person. So you're looking at over $26 million that you can gift in an ownership interest of your company to your kids or to your family or your sisters or brother.
Yep.
That's a huge tax benefit. And if you're valuing a non-controlling interest, something less than 50%, the IRS allows you to take valuation discounts. And these valuation discounts include discounts for lack of control and lack of marketability, right? So they're two separate discounts. So if you own a 15% interest in a company, obviously you don't have control. You have no say in management. So there's obviously, if you're looking at buying a 15% interest in this company, you're just saying, I'm going along for the ride, right? That's all you're doing, right? So there's a discount for that. You're not going to pay a full value for that when you can't control anything.
Right.
And then same with marketability, right? So if you look at discounts for lack of marketability, if you have a small middle market company and you're trying to sell it, it may take a year, 2 years to sell, 3 years to sell, right? So there's a discount for that as well. It's not like a piece of real estate where you can sell a home and typically it sells within 3 to 6 months or something shorter than that.
Yeah, those smaller companies can take longer to sell, to your point, because you're looking for more strategic buyers usually, or somebody who's just trying to get, maybe looking to buy their first business or something like that, somebody who's had a job for a while and now they're looking to do something a little different. I am personally seeing a lot of people in their 30s that are looking to try and go like the search fund model, where they're looking to buy some of these smaller companies. Maybe they're $250,000, $500,000 of EBITDA. Like those are becoming very popular to some of those types of buyers. So.
Sure. Don, I think that was an interesting point talking about the discounts as it relates to tax valuation, right? Because in the marketplace, you hear often, if I'm going to sell the company completely, It's one valuation. And if you're going to value it for tax purposes, but that's interesting. So the discounts really support that lower value that you often see.
Correct. And the IRS allows it. So why not take advantage of it?
Sure.
Yeah.
Sure.
I will say, are you seeing a lot of people getting their valuations done for this potential sunset of the gift tax laws?
Oh yeah, definitely. There's a lot of people that are trying to get this in because you just don't know what's going to happen. We might have divided government. You don't know what if Congress is going to reenact those Tax Cuts and Jobs Act from 2017. So there's just a lot of uncertainty. So a lot of people are looking to get this in before 12/31/2025.
And just interestingly, are you seeing the professionals, their trusted advisors, send them over to you, or is it more so that they're aware of it? Because I think a lot of people are not aware.
Right.
You're 100% right. It's not the business owners that are aware of it. It's their financial advisors and their attorneys that are. You need to gift this now.
Yeah. Well, that's the important. Again, going back to that
important part of having good partners.
Yeah.
Qualified partners and people who are operating in that space. I mean, Joe and I will say it 1,000 more times. So pivoting from kind of the tax perspective, I know you're an expert witness and you've been testifying multiple times. Can you talk to us about kind of the litigation and dispute resolution area of valuation?
Sure. So about 50% of my business is mainly just regular business valuation. That's non-contentious. Either it's for somebody's looking to sell a company or they just want to know what their company's worth. And the other 50% is litigation related. So I've got quite a bit of experience in the litigation arena. It's can be difficult. Typically, you're going to have two attorneys, two experts. You're going to kind of be battling over the value, right? So that I think Joe mentioned earlier, valuation is somewhat subjective. So you could have widely different results on valuations, which can be frustrating. And when you're trying to make a deal,
yeah,
right?
Of course.
So,
and so you're seeing a lot of so obviously divorce proceedings are one area, but like shareholder dispute type situations?
Correct. Shareholder disputes, diminution in value, high net worth family law cases. Obviously, the divorce rate in the United States is somewhere around 50%. So if there's a business that's involved and it was a marital asset at that time, that would need to be valued. So that's another big part of our business as well.
Yeah. And to your point, I actually sent something over to you in the earlier part of this year. It was a shareholder dispute, and one of the partners was being kind of blocked out. So maybe we can use that as kind of an example of the kind of situations you see where these valuations do become very important.
Right. Sure. So in this example, it was a restaurant bar. The minority shareholder has been pretty much shut out of the company for the last 10 years, hasn't really received any information or very little distributions, and he got fed up, and he's like, I want to get bought out. And so we started a litigation process on this and requested a bunch of documents, which included tax returns, financial statements, and more importantly, bank statements. So especially for a restaurant or bar. So as part of that analysis, I went through and looked at 4 years of bank statements, and the common theme that I found in those bank statements is that none of the cash was being reported. So that's usually an issue when you're doing a valuation and there's no cash from a bar, restaurant, right? So you have to get somewhat creative when you're doing this type of valuation. And the one thing I did look at, there's a payment processor, TSYS, I think it stands for Total Systems Inc. or something like that. But they provide a study every several years, and it talks about overall payment methods. The number one payment method is still debit card, then followed by credit card, and then lastly it's cash. And the study that they have provided showed about 14% of people still pay in cash. Especially if you're at a bar or a Coney Island, a lot of people, you're going to see a lot more cash.
Sure.
Right?
Don't want your wife to know all those drinks you're having.
Yeah, if you're going to Ocean Prime in Troy, you're usually not paying cash. That's usually going on a credit card. So what we did is we looked at, here's the total revenue from the bank statements, and then we added an additional 14% for unreported cash. It's not the best way to do it, but when you don't have any cash that's being reported, that's one way to at least look at it, to can at least start a conversation to try to come up to a settlement.
Sure.
That's super inventive.
It is.
It's a great way to kind of come around to, here's what's going on. Why is this not being shown appropriately?
Obviously, it being reported would be the preferred method, but you didn't have that, so you had to come up with an alternative way of supporting how you got to those numbers. That's fascinating.
Yeah, it really is.
Really is. Well, Don, I pivoting again, talking about different types of valuations and the tiers. From a banker's perspective, familiar with the SBA valuation process where we need that to support our financing. I imagine that looks a little bit different than doing a valuation for tax purposes or doing a valuation for a non-SBA transaction. Can you kind of talk to us about the different types?
Sure. So for an SBA valuation, you can typically use a summary valuation report that'll give you all your valuation schedules and how you came up with your value. For a gift tax report, or if you're gifting an interest if you're gifting an ownership interest in a company, that report requires a revenue ruling 5960 report, which is pretty significant. It could be upwards of 100 pages, and it includes a detailed analysis of the company's history, an economic analysis, industry analysis, detailed financial analysis, and valuation analysis. And then the other part of that is the discounts for lack of control and lack of marketability, which could make up 20 pages of that valuation report, just looking at the overall risk as a minority shareholder in terms of what those discounts look like.
So definitely different levels, and I assume different costs.
Correct.
Based on the time and what's needed.
Sure.
Okay.
And then, to do the SBA valuations, I take it to be like a valuation expert. It's very similar with like the equipment appraisals and the real estate appraisal. Like you've got to be on an approved vendor list for the banks in order to do their valuations and all that kind of stuff. Because, to your point, like they are very important in SBA transactions. Like you can have an airball in a collateral position for a transaction that's going through the SBA, but it's got to be backed up by that.
Right.
By that business valuation.
Right. The bank offering an SBA loan is only able to lend up to the business value. So the difference has to come from somewhere.
Yep.
Whether that's more cash in, or if there's a seller note involved, maybe the seller taking a little bit more back. But yeah, the SBA lending purposes, you need to be able to support the purchase price and the amount you're going to finance with the valuation.
Yeah.
So it is kind of amazing that only needs a summary report when you think about financing, but I guess it's different tiers and different reasons, so it makes sense.
Yeah. Okay, so we've talked about some of the uses.
Mm-hmm.
Now let's get a little bit more complicated, and let's talk about how they're actually done.
Okay.
Because there's a lot of different approaches, and you're looking at a lot of different things in each of the approaches, right?
Correct.
Okay, so there's three main ones, right? So there's the income approach, which we've talked about with you before the podcast.
Mm-hmm. Right.
There's the market approach, and then there's the asset approach. So why don't you start off and just give us an idea of like how the income approach is approached, and maybe we'll just run through each one of these and go through it in that manner.
What's the recipe?
Yeah, right.
So under an income approach, there's really two valuation approaches. There's the capitalization of cash flow method and the discounted cash flow method. I'll start with the capitalization of cash flow method. And what this represents is a company that's mature, steady earnings, steady revenue. You can then take, you usually look at 5 years of financial statements, do a 5-year spread of the balance sheet, income statement of cash flows. And if it's relatively similar from year to year, you can utilize the capitalization of cash flow method, which what you would do with that is you would forecast 1 year into the future, and it would be pretty much based on the last 5 years as to what they've done. And then you could reasonably expect that they'll continue to grow at a rate equal to inflation. So that's one way of looking at it. The other method is the discounted cash flow method, which is for younger growing companies. And typically this is a 5-year analysis that's spread out over 5 years. And then you look at a residual period. So you do a 5-year projection, and then you say, okay, now we're at stability after 5 years. And then this is kind of where they're going to be in the residual period. So then you're capitalizing that residual period into the future. So those are really the two differences between the income approach, between the capitalization of cash flow method and the discounted cash flow method.
And those are, using the right method is so important. So I got to tell you, like lately I'm going crazy because I'm going into companies where I'm being brought in by a trusted advisor, and they want to know what their company is worth. And somebody has come along and used a DCF model to put an exorbitant price on a business that is, to your point, you said something usually like more early stage. These are mature companies that have been around for 30, 40 years. And there's I don't know if they're professionals or they're obviously not standing behind these numbers because they're going out there and giving them valuations that are probably 3 times what the business is actually worth based upon historical performance. And I get it. Like you want to normalize and you want to make the best case for like the best price possible. But if you're giving somebody a $9 million valuation on a company that's realistically only going to sell for $3 million, like that's a huge disservice to the client.
You're not helping anybody.
Yeah, exactly. You're setting unrealistic expectations, and that person is going to go to market, and they're probably going to blanket the market. They're going to have a failed process, and it's going to be a huge issue. So like choosing the right method is so important.
It matters, definitely.
Yeah, that's super helpful.
And I guess just along those lines, there's probably space in between that example and using kind of the stable earnings for a growth scenario. Is there any time that you would use a DCF for maybe somebody who has been stable, but maybe they're entering a new market? Or maybe they have new technology. Is there kind of a blended option?
Yeah, well, that's a perfect time to use a discounted cash flow, right? So if they've been steady historically, but like you said, now they're offering a new service or a new product line, right? So obviously the company's going to grow. You can't utilize a capitalization and cash flow model in that method, right?
Okay.
So you're looking at, okay, they're going to have growth rates of, say, 20% year 1, 15% year 2, 10%. So kind of more of on a declining basis. But you want to be able to factor that in a capitalization and cash flow model, which is why it's important then to switch over to the DCF, discounted cash flow model, to forecast that cash flow.
Okay.
Right.
That doesn't get you to 3 times the value, but it gives you some kind of look at a projection basis.
And,
Sure.
and to be clear, I've seen that situation recently too. We proposed on the sale of a company that their EBITDA was basically going from 1.5 to 3.5 million, and it was because they were getting a new program.
Right.
It was a long-term program. It was a 3-year program. So like there are appropriate situations where you can apply these types of things, right?
But you don't get to an outrageous number that way, which is unfortunate because, like you guys said, you're doing a disservice to the client, but then the client's going to have a bear of a time in the market and probably frustrate them about the process.
Yep.
And probably about all the professional service providers that they come in contact with. They're going to mentally put them in the bucket of they lied to me or they gave me the wrong information. So it's just not good to have, dishonest numbers.
Sure.
Mm-hmm.
Be reasonable in general.
Right.
Just be reasonable, right? I mean, it sounds great to tell somebody, oh, your company's worth X amount of money when it's really not, because you get that initial high from it.
Right.
But be reasonable with people. That's what they want.
Sure.
Absolutely.
Right.
Okay, so income approach, market approach.
Sure. So the market approach is another method that we use. We usually don't use it exclusively. We'll use it as a corroborating method, right, to support our income approach. Oftentimes, if you see a big difference between your income approach and market approach, there's something wrong there. So for example, market approach, when we utilize this, we have databases that summarize transactions that have sold. And you can take it by revenue, you can take it by EBITDA or seller's discretionary earnings. So you can look at it from different scenarios. And what's important about the market approach is that you need to have enough transactions too. Sometimes you can't look at, if you have a unique company and there's 3 transactions. I wouldn't rely on the market approach if you only have 3 transactions, right? That's just not enough. But if you're valuing a restaurant or something like that, there's thousands of transactions on these databases.
Mm-hmm.
So you can certainly get an idea of kind of what that looks like. For example, like restaurants typically sell for 30 to 50% of revenue. That's usually the going rate for those, depending on the restaurant. So, but we certainly look at the market approach. We always look at it. It just makes sense to, again, just corroborate our income approach.
And you have to make sure you're pulling the right comparisons, right? Like
Correct.
that I will tell you, I've seen people again on some of these smaller transactions. Maybe it's just because there's limited data. I don't know, but pulling a $500 million transaction that went at, that was 50 million EBITDA is not a good comparison to something that's doing 2 million or 3 million EBITDA or even 5 million EBITDA. Like there's a drastic difference. Multiples change drastically based upon industry. It changes based upon how big the company is. Like it's going to change how many buyers are going to be interested in the deal. So that, again, if you can't tell, another that one gets me a lot.
Yeah. Right. No, it's just honest with the numbers and realistic. And trying to find the best way to get there, and having the support of both of those methods when you're kind of looking at value makes a ton of sense.
Sure. Yeah. And then outside of that, those databases that we utilize, we also look at guideline public companies, right? So you can look at publicly traded companies. You can obviously get financials right from Yahoo Finance or any of these other
Right.
Google. You can get these financial statements, so you can kind of calculate what those implied EBITDA valuation multiples are for those public companies. Now, oftentimes, if you're valuing a small middle market company, you're not going to utilize a 15 times EBITDA multiple
Right.
based on what the public companies are. But there are ways where you could adjust them for size, right? So you can say, look at this company's, a $300 million, $300 million company. I'm a $5 million company.
Yeah.
You can adjust those multiples for size and get it to a more realistic number.
That sounds more realistic to me, rather than just going, yep, 10 times.
Right. Right.
Okay, all right, let's talk about one of these situations where there's not, a bunch of cash flow for you to work with. Now you're talking about the asset approach. Give us a little detail on that and kind of where those situations apply and how you go about it.
Certainly. So I've got a case right now where I'm valuing a mobile home park, and there was a real estate appraisal done. So I have a certified real estate appraisal, so I'm able to do an asset approach, right? So I take they have the book value of the real estate, but now I have the appraised value of it. So you take the book value numbers and then you move it to the market value of what these are worth. So you're able to do it that way as well.
Yep.
So you can say, okay, it was as book value, it's 10 million, it's worth 28 million. So now I got $28 million in real estate. You add back the cash, you look at whatever other assets they may have and subtract the debt, and then you can kind of come up with a value based on the overall balance sheet of the company. The other method to look at an asset approach is for companies that are either capital intensive and losing money, and they're almost better off dead than alive. We see that quite often. So you'll kind of look at more of a liquidation value or a breakup value at that point.
Okay, so it's going to be very common when you're in bankruptcy situations, looking at entering into, looking at your options maybe, and then liquidation situations, which are obviously very similar situations.
Right.
Sure.
Distressed is when you most often see an asset approach.
For the most part. Yeah.
Okay.
And we'll get into more of industries later, but and I think we touched on these a little bit in each of these. But can you tell me what industries each of these approaches would be? So, let's just start with the income approach. What are the industries you're typically going to see in there?
Oh, you're going to see. I mean, that's most companies are going to go the income approach. To be honest with you,
Okay.
I mean, you got manufacturing, you got dental office. I mean, a lot of these companies that are making money really goes into the income approach. So
Okay.
you should always be considering an income approach.
Okay, and then
every
market,
valuation.
same question for market and asset.
Yeah, so depending on the market, right? So there's certain transactions, you may have a very unique company and you just can't use a market approach. As I mentioned before, there's just not enough transactions to really pull from. And so you really need to rely on that income approach.
Okay. And then asset is,
Asset.
you can kind of apply it across the board. Right?
Correct.
Yeah, okay. That's great. I appreciate that.
And then I guess kind of recapping that, are there certain methods used in each type of approach? Like, are you valuing, you mentioned seller's discretionary earnings or EBITDA, kind of what falls in line with which approach?
Certainly. So when you're looking at an income or market approach, ultimately it's gonna spit out, for lack of a better term, a multiple, right? So you look at the overall enterprise enterprise value that was determined under an income approach or market approach, and then you would divide that. In this case, you would look at the latest 12 months EBITDA, right? And you would divide that enterprise value by that EBITDA, and that would give you a multiple. And maybe that multiple is 4 or 5 times. You look at the industry and you said, okay, that's kind of right in range where that is. So it gives you a little bit more comfort
Right.
when you're looking at that. When you're looking at these, because a lot of people will just throw out, what's the multiple? Well, it's not that simple.
Right.
Right. You got to do a detailed analysis of the company. And it ultimately results in a multiple, but there's a lot of work that goes into that multiple versus somebody just saying it's 5 times EBITDA. It's not that simple.
Right. Yeah. When people ask me about exactly that, like, what's the multiple? It's like, hey, this is a general idea of what
Sure.
we're talking about.
Sure.
Here.
Right.
Like, I got to be very careful. Like, I only have so much information, and that's not, like, valuation is not my specialty. Obviously, I see a lot of transactions, and I see what they're going for, so I can give you a general idea based upon industry and that kind of stuff, and access to certain programs like PitchBook and all that kind of stuff that have industry data. But
Sure.
yeah.
You can have a conversation
Yeah,
about
exactly.
a rough multiple, but it makes sense to get a full one completed so then you can have a better conversation with them and when you're going to market.
Right.
I imagine.
And another item to talk about is just the overall adjustments when you're doing a valuation, right? So if you own the business and you own the real estate, you can be paying yourself whatever you want in real estate, right? So, but when you're doing a valuation and you if you're going to sell the company, well, what would a third party pay, right? So
Right.
it could be very different. So if I own the business and I want to pay myself $500,000 in rent and it's only fair market value, or a third party rent's only $100,000, you're going to add back another $400,000,
Yeah.
right? And that'll just increase the EBITDA. And then if people are taking excessive trips all the time, right? So we see that a lot. And
People don't run expenses through their companies, do they?
it's unbelievable what I've seen.
Oh, I can only imagine.
I mean, I've seen people kind of running your kids' college tuition through there.
Oh, wow.
It's unbelievable. So, but you definitely have to do a deep dive into the financial statements, and we also always ask for general ledgers to kind of go through each expense item and see if something jumps out at us.
Right. So you're saying these aren't simple? Like
Yeah, there's more to it.
There's a lot to it.
Yeah. Well, I guess along those lines, Don, what are you looking at when you're performing a valuation? If, I'm saying, hey, Don, can you value my company? What am I going to have to provide to allow you to get to a number?
Sure. Definitely 5 years of financial statements and tax returns. And then current year-to-date information, right? That's the most important information. But then we're also going to want to have copies of your real estate leases and depreciation schedules, and we're going to really it's not an audit, but we're
Sure.
diving into your business,
Right.
and we're trying to figure out what this thing is worth. Accounts receivable agings, right? So if all of a sudden you look at your accounts receivable aging and most of them are 180 days out, right? Well, that's a problem. So that's something that we would need to know when we're doing the business valuation. So we ask for quite a bit of information when we're doing a business valuation.
when you're looking at projected future performance, do you usually have to apply some kind of discount rate to that?
Essentially, that's captured in the cost of equity, right? So if somebody provides us projections and they seem reasonable to us based on what they've done historically, it may not move that cost of equity that much. But if it's all of a sudden they're growing 20, 30, 40%, well, wait a minute. Like, you haven't proved that you've been able to do this yet. I'll need some more information to come up with that.
So in that same vein, so you get abnormal years of operation. So 2020, COVID hits. That had to cause havoc in the valuation
I can only imagine.
industry.
It was unbelievable. We had no idea what to do. I'm not going to lie at that time, because March of 2020 and April of 2020, we weren't sure if this was going to go on for 2 years, 3 years, 4 years.
Yeah.
How many people were going to die from this? How many businesses were just going to go completely under?
Yeah.
So it was very difficult. We in certain cases we did have to do business valuations during that time, and it was very difficult. Obviously, there was a lot more risk involved in that. So when we talk about that weighted average cost of capital and that cost of equity, there was obviously a lot more risk in that. So that would increase the cost of equity, which would then lower the overall value.
Yep.
Just because of the unknown.
Yeah.
Okay.
Yeah, I'm not envious of anybody who had to. Look, I'm sure the same was for equipment and real estate appraisers,
Sure.
because
Right.
like you're like, look,
How do I value?
Yeah, if a manufacturing plant is shut down, is there going to be a glut of inventory, or is there going to be a glut of equipment out there that's available? Our business is going to close down, all those kind of things. So I'm sure it caused havoc throughout the industry.
Yeah, and in some of the family law cases that I was working on, what we would do is we would say, okay, we're going to do a value now, but then we're going to look at it in a year.
Yeah.
Right, and just
Right.
and make sure that it made sense at that point, because it would be unfair for either party, right? So that was one of the items that we looked at.
Well, luckily, not a lot of people were getting divorced because they had to stay in the same house.
Right.
Or a lot of people did get divorced
Yeah,
because
as a result.
after the fact.
After the fact,
Yeah,
right.
So, Don, quick question about that. I mean, as we get further and further away, right now you're probably capturing pre-COVID financials. What do you anticipate? Is the 5-year mark really it? And then you start looking at stuff post-COVID, or does it vary by situation?
Yeah, it varies by the company, right? So if they've had steady earnings, well, then obviously it didn't affect them that much. Certainly, when you look at COVID years, if you look at dentists or plastic surgeons, they weren't doing anything during COVID. Everything was shut down at that point. So I'm not looking at 2020 or 2021 at that point. I'm looking at 22, 23, right? For those types of companies.
Yeah, that's interesting. And it's just abnormal operation, right? You just can't use it.
And what's nice is that we go back to 2019, so we can see where it was in 19, skip 2020 or 2021, and then see, okay, maybe they're similar to what they were doing. And I got a perfect example of this. I just recently did a valuation of a funeral home in Detroit.
Okay.
And we had to do a valuation, pre-marriage, and that was in 2018. So we had looked at 2018, 2019, and then we also looked at it currently. And you could see a huge increase in revenue in 2020 and 2021, obviously because of of COVID and how that impacted everybody. In this case, we looked at the overall value, and the value did not increase from the date of marriage until 2023 because it went up, but then it went right back down to where it was, right? Normalized out over time. So there really was no increase in value, except for those 2 years of COVID.
So in the situation where you throw a year out like that, are you going back one more year? So like, let's say you threw out 20 and you would have just gone back to 19. Will you now throw out 20 and go back to 18?
I'll go back to 18.
Okay.
Yeah, exactly.
Okay. Interesting. That's super interesting.
Especially for a stable business like that. Like funeral homes are usually pretty steady in terms of, unfortunately, but they're usually pretty steady in terms of.
Might have been a spike there.
Yeah, right.
Exactly.
Probably shouldn't be laughing about that, but
Well, no, I mean, it makes sense though. There's ups and downs, and some people came out better business-wise.
Yeah.
Some people were impacted immensely. Some people, benefited from the situation particular to the business.
Specifically to PPP funds. I mean,
Sure.
how many companies got PPP funds that didn't even need it?
Yeah.
Right.
They were all forgiven. So, which leads to leads to inflation and all this other stuff that happened, right?
How did you guys deal with PPP funds in the PPP, EIDL, ERC,
Sure.
employee retention tax credits? How do you guys look at those in part of a valuation process?
One-time event.
Okay. So you're just
we just
throw them out the window.
we threw it out. We threw it
Okay.
out.
Yeah, I figured as much, but
Yeah.
you never know. Trust
Ultimately,
me, a
ended up in there.
lot of business owners want to keep it in
Right.
the valuation, and I tell them they can't. And then, on the other side of that, in terms of working with lenders that like shortly after or in the middle of that COVID range, the banks weren't considering that as part of cash flow, right?
And it's a hard discussion because you could argue the business owner would have acted differently did they not have access to those funds.
Correct.
Absolutely.
So it's kind of
point.
a balance. We talk about this with credit all the time is how do you weight that? Because they could have cut expenses. They could have reduced headcount. There's things they could have done had they not gotten those funds.
Yeah.
So it's a dynamic question for sure.
Okay. I think we've covered that. Let's jump into industry and how it plays into valuation.
Yeah.
Because, we've of course, we've been touching on this as we've gone along in the conversation, but like, can you kind of recap for us how the industry is going to play into your valuation? So we talked about how, tech companies have huge valuations, and it's basically like, can you just kind of run through quickly again how those play into the valuation picture?
Sure. So whenever we do evaluation, we always look at the industry in which it operates in, obviously.
Right.
And we utilize data from IBIZ, which is a publication that they give you detailed analysis for each industry. And it'll usually give you projections as to what the industry is going to do over the next 3 to 5 years,
Yep.
which is
Great
helpful.
resource, by the
Right,
way.
great resource.
Yeah.
And then another one that we use sometimes is First Research. Similar, I would say IBIZ is a little bit better and has a little bit more detail. But we certainly always look at industry conditions for whatever industry you're valuing.
Okay. So let's use an example of an interesting industry that is newer in the state of Michigan. I think a lot of states, I'm not sure what it is, but I think the majority of the states in the U.S. have now legalized it. The marijuana industry. So when did recreational start? In 2019?
I think it was before that.
Okay, it doesn't seem like it's been around forever, but I know obviously
it's been around forever.
it grew a lot during COVID. Like we watched the state of Michigan. Like I think the revenue now surpasses the alcohol industry in Michigan.
We're up in smoke, right? So.
Yeah, right. So maybe talk a little bit about how you've seen valuations change in that industry, because there's been a lot of ups and downs in that industry.
Huge up and down. So when we first started valuing cannabis companies, it was always very difficult because at any point the federal government could just drop the hammer and say, no, you guys are done, right? So when I was talking about those cost of equities for those startup companies, when they were using 40, 50, 60%, that's what you were using for valuing those companies, cannabis companies back then, because you had no idea what the government was doing. There was a few states that started doing it, and then more and more states. But now I think the government likes it, and I don't think they're going to change anything, right? So right now, marijuana companies are taxed at gross profit, so they can't deduct any of their operating expenses. So the U.S. government is making a ton of money off cannabis, and so are the states that are also running this. However, what's happening now is that a lot of the bigger players are getting in, and the cost of marijuana has gone down drastically. So there's right now, in industry changes and conditions change from year to year or every 6 months or so. But right now, there's really not a lot of money in marijuana. Now there's certain exceptions. So there's, if you look at New Buffalo, which is right on the Indiana border, but still in Michigan, I think there's 25 or 30 cannabis stores that are located there, and they all just came in recently. And obviously Indiana does not allow marijuana, so a lot of the people from Indiana, even Chicago, will drive to Michigan and get those. So those companies may be doing well.
Yep.
But it's amazing what industry can do from year to year or 6 months to 6 months, right?
Yeah.
So,
Sure.
it's quite
Yeah, and
interesting.
if you talk to any of the smaller operators, you can see the pain in their face right now. So it's very interesting how you see these articles all the time about how the cost of it and per ounce or pound or whatever it's judged on is just so low right now. Like half these businesses can't stay in business.
Correct.
I mean, I was at an industry event and you could just see in their faces like the absolute pain that they were experiencing because there's still a lot of illegal product out there that's somehow making it into the market and it's dropping the cost for or the purchase price for in the marketplace. So
Sure.
So very, very interesting.
So Don, just thinking about that particular industry from a banking lens, even though it is legal in the state, all federal regulated banks aren't involved in deposit taking, loan making, that kind of stuff. Are you seeing that in any space? I mean, are state banks doing it or credit unions? Who have you seen use the valuations for these companies?
Yeah, there's some small community banks that are doing it that are in Michigan. I don't want to list any names
Sure.
of those, obviously, but there are some that are still doing it. But it's still mainly cash, right? Obviously,
Right.
that's what it is. So
Right.
it's interesting. I think at some point something has to change with this, right?
Sure.
You can't have this much cash.
Right,
right.
right.
So,
Absolutely.
It was good to dive into that specific kind of unique industry, and I imagine there's nuances to every industry, right?
Sure.
I think it's probably fair to say that it's dynamic valuations. It's not just very stable, and that's case by case.
Correct.
So we've kind of laid the groundwork for what a valuation looks like and how it's accomplished and what the recipe is. Why do Joe and I see different valuations for the same company? What drives that?
Sure. If it's in a litigation situation where you have two experts and you have two attorneys, and depending on what side of the aisle you're on, you can see some pretty vast differences in valuation. I've always held myself, my only asset is my professional reputation, and I don't care who I'm working for. I put a value on it what I think it's worth, and that's just what I do. And sometimes there's other people out there, and most people I think are like me, but there's a handful of people out there that will just put a higher value because the attorney wants them, and
Sure.
I just don't think that's the proper way to do business. So,
And you have to look. You have to have certain certifications, or maybe you don't have to have them, but many do.
should.
But you also have to have like insurance and all that kind of stuff because you're standing behind. You're signing your name at the bottom of the valuation,
Absolutely.
right?
Right.
So I take it the insurance for valuation industry is not super cheap because there are situations of litigation and all this kind of
correct.
stuff.
Yep. Absolutely.
So
Yeah.
that's super interesting.
So being qualified and certified, I mean, that goes into the bucket of what you should look for. What other things would you point out to people listening to keep in mind as they're deciding on a valuation expert?
Sure. Just make sure that this is what they do for a living. So there's a lot of people, I love the CPA profession, but there's a lot of, smaller CPA firms where a guy gets a certification over a weekend and all of a sudden he's a valuation expert and, he does it outside of tax season, but, during busy season, he's not doing any valuations. So I would stay away from people that are, doing one or two a year and find somebody that this is what they do for a living.
Yeah. Are there certain certifications that you should be looking for? Like, are there certain ones that in the industry you're going to see people have?
Sure. So I have a accredited senior appraiser designation through the American Society of Appraisers. It's called the ASA.
Okay.
I'm also a certified valuation analyst. That's through the National Association of Certified Valuation Analysts. And then the other one is the CFA, Chartered Financial Analyst. Those are really the three big ones. And then from the AICPA, they have the Accredited in Business Valuation, ABV. That's another well-recognized.
Are these like with a CPA? Is this the same kind of situation where there's like continuing education requirements?
Correct.
Okay.
So for me,
you're always
every 50, or I have to do 50 hours every year.
Okay.
in continuing education.
Okay.
So,
it's a week of work.
which I still have.
You're not billing.
Which I still have 30 to do before the end of the year. So.
Get to it, Don.
Exactly.
Okay. You got anything else to cover?
No, I think we dived into a lot of stuff, and I appreciate you kind of shedding some light on the way we get there, the different types and kind of the situations where they're used, because I think that's a big key. You know, we see them for a lot of different reasons, but I just really appreciate you being with us. I think it's pretty informative for both Joe and I, but also for everybody listening.
Yeah, this was awesome. Okay, so let's do a brief recap. We've talked about where valuations are used. We've talked about how the appraiser is looking at a valuation and the different methods and how they're appropriate for certain industries. We've talked about the professionals that are going to be using them, which is, you know, your bankers, your M&A transactions, all those kind of things. And probably most importantly, who is going to do your valuation and how do you know how to choose them, right?
Sure.
I mean, that would be, let's be honest, a lot of people are not going to have valuations done very often.
Right.
Because they don't know about them and how they apply. So I think providing that kind of detail to people is super important. So as Shawn said, like, we really appreciate you coming on and discussing this.
I appreciate it. I start every year with revenue at 0. I don't have annuity work, generally speaking. I mean, I'll get some repeat customers, but I start every year at 0. So.
Yeah, I trust me, I know how that goes. The transaction world
exactly,
okay. So that being said, we like to do a
favorite
nice a nice little fun wrap up at the end, which is talking about maybe a favorite spot that you like to go for breakfast, lunch, drinks, dinner, whatever it may be, where you do some networking and specifically networking around the transaction world.
Sure.
So what do you have any favorite spots? Why don't you illuminate us a little bit?
I do. I got 2 spots. My office is located at Squirrel Lake and Woodward in Bloomfield Hills, and I'm in walking distance to the Moose Preserve. Love that place.
Okay.
Love their food there. So I frequent there quite often. My other favorite place is Bo's Grill at Maple and Telegraph.
Yep.
Just love the ambiance in there, and I just feel like every time you go there, you always run into somebody. So which is a good spot to be.
Absolutely, and it's funny that you bring up those two because I'm pretty sure last time I had lunch with you and some of your partners, we went to Moose Preserve, and I think I'm actually the one who brought up Bo's
did
in an
on.
earlier episode because I just think it's a great spot, and I know Shawn loves the Library of Booze up there.
The Library of Booze, and it's centrally located right on Telegraph Corridor, so you can get there pretty easy no matter where you're coming from. So
And
it's a
by
great
the
one.
way, Moose Preserve has a pretty cool inside. Like,
It does.
It's very unique.
Yeah, it is. It's very unique.
Very rustic.
Yep, absolutely.
Well, thanks everybody for tuning in to this episode of Making the Deal, Frameworks for Transactions. Be sure to check us out on YouTube, LinkedIn, coming soon, Apple and Spotify. We encourage feedback. We really want to hear everybody's thoughts on what we're talking about. And if there's anything that you'd like to see covered, let us know. I'm Shawn Marcino.
I'm Joe Allen.
Thank you, Don, for joining us.
Thank you. Appreciate it.